Good afternoon, everyone, and welcome to today's webinar. We've got a short and sweet webinar for you today where we are going to be looking at prior year adjustments. So my name is Tom Jeffrey. I'm one of the education and media technicians at CaseWare UK. I'm joined by Jack Holloway, one of our EMT consultants. Jack's going to be taking you through the presentation. That's Jack on the left there. Jack will be taking you through the presentation. I'm going to be on hand to monitor and answer your questions. I will do my best to answer your questions. We are going to have a Q&A session at the end, and we'll answer as many as we can. If we don't get back to you during the session, don't worry, we'll get back to you directly after the webinar. Also, we're going to be publishing a recording. We are recording this session. That's going to go onto the knowledge base as usual, and also onto our client services YouTube channel. We'll make you aware of those recordings when they're available. And to accompany those, there'll be a Q&A document which will include any questions that come up during the session. So you can see the housekeeping there. We've also got the option for hand raising. We'll see how we go. As I say, we've only got 20 minutes, so we are a bit tight for time. But if you wanted to ask a question live via your microphone, you can do so using the hand raising feature there. Alternatively, just use the question field in the GoToWebinar control panel. So I'll hand you over to Jack and we'll get started.
Thank you, Tom. Yeah, hi everyone. Thank you for joining us. As Tom said, short and sweet today on prior year adjustments. So we're just going to run through some of the basics, obviously aimed at sort of beginners today. So just a very quick run through of the agenda so we can get cracking. First of all, we've got why are they needed? Okay, so prior year adjustments will obviously, there's two main reasons, but we'll go through those in a second. We're then going to jump into a worked example. Okay, so we will run through just a little example that we've taken from our training data so that you guys can see how this works in CaseWare, see it in action. We'll then jump into CaseWare and make the entries that we need to make in there, show you the effects on the financial statements. So we're going to be looking at the tangible fixed assets note as well. I'm going to also show you the stocks note to show you the differences between those two. And then just some other considerations and the Q&A at the end. Okay, so first of all, just to get an idea of you guys that are on here today, we're just going to run a very quick poll on why you guys need to use these prior year adjustments as they come up. Okay, so the main reasons that they're needed are the material adjustments due to accounting policy changes. So those of you that have been going through the IFRS and FRS 101 accounts, these may affect you. They're dealt with in a slightly different way, and I'll mention that later on when we get to the different map codes that are available. Okay. And the other one is a correction of errors in the prior period accounts, which is what we're going to be going through our example on today, just to make sure that it's illustrated in a way that you guys can see most eventualities. But we will go for that when we come to it. But Tom, if you want to fire that poll up, that'd be great.
So that's on the screen there now. As it says at the bottom of the screen there, organisers and panelists don't vote. So it's not a fix. We're not going to be rigging the votes. They are going to be completely transparent and honest. And seeing them coming in.
Oh, sorry. No, go on, Tom. No, go on.
seeing them come in, actually, I think it's pretty clear. I'll put the results up on the screen in a sec after we've given you a bit more time to submit your responses, but I think it's pretty clear which one is more common. Okay, I think that gives us a good idea. So I'm going to close that now and I'll show the results on the screen. So 88% correcting errors in the prior period accounts, 13 doesn't quite add up, but 13% changes in accounting policies.
Okay, perfect. Cheers for that, Tom.
Okay, no problem. I'll close that now.
Thanks, guys, for answering that. Yeah, so the way that you deal with the errors in CaseWare, as we'll go through in a moment, doesn't change too much depending on which one the reason is. So this will help you regardless of what the changes are. But we're using errors today just as an example because we can show you a little bit more and there may be a few more consequences through the errors than there would be in the changes in accounting policies. Okay, so I'll jump on to the next slide. So to go through the example, we're going to look at depreciation in plant and machinery. Okay, so in this example, we're going to say that for the last 5 years, it's been understated in the accounts. The depreciation has been understated in the accounts by £5,000 per year. Okay, so if we add those 5 years up over that 5-year period, there's been a cumulative effect of £25,000 over that time. Okay, so that's just a little bit to sort of illustrate how this is going to work. Now, the way that we do prior year adjustments in CaseWare, and this obviously there are a few different routes to this, but this is the most efficient way and the way that we recommend using. There are 4 steps to go through making that prior year adjustment. Okay. Now, step 1 is to manually adjust the prior year trial balance. Now, the reason for that is we suggest doing the prior year trial balance first so that it flows through into the current year numbers. Okay. Now, where you've got a situation with retained earnings changing, being in step 3, that's where we'll then use the prior year adjustment map code. Okay, as we'll show you in our example in a moment. You've then got step 4, which is showing the restated option. So there's a place in the table in the note setup when we go through that in CaseWare. There's a place under the table options to add the prior year restated or as restated into the prior year column, and we'll show you that in a few moments as well. Now, the reason I mentioned that one today at this point, there are in the tangible fixed assets note, there is a row where you insert that data, and that's what we'll be using in our example today, but I'll show you both of those in a moment. Okay, so if I jump to the next slide. So in our example, if we start with step 1, we're just going to work out, first of all, the prior year adjustment comparative figures. So the effect that this will have on just prior year 1. We're going to ignore prior years 2 to 5 for a moment, and we'll work that out in a minute, but just prior year 1. It means that the depreciation will have been overstated in that period understated in that period by 5,000. Okay. Now, what we're going to do for that part of the journal is just a simple debit the depreciation in the P&L because the cost is going to increase for that one period only, and we're going to credit the balance sheet side of the depreciation by 5,000 each. Okay, and that's just to show the effect on the comparatives in that 1 year only. Okay, now the next step that we are going to jump into is the same step, but the second part of that journal will be working out the effect on prior years 2 to 5. Okay, now when we're doing that, we've got a situation where there's 4 years worth of depreciation that was understated hitting the brought forwards in the plant and machinery depreciation codes. Okay, now to make that effect roll up into one adjustment, we're going to have to credit the brought forward depreciation in the prior year. Okay, and that then will take into account the effect of prior years 2 to 5. So 4 times 5,000 being 20,000. We're going to credit the brought forward depreciation here, and we're going to debit the retained earnings brought forward. Okay, now quite key here is that in the prior year adjustment, we debit the retained earnings account brought forward, not the prior year adjustments account. Okay, so just to flag that up there. Now the next step after that is adjusting the current year balances. So we've now had these effects that have taken place on the prior year data. Okay, and the overall cumulative effect of that needs to be adjusted in the current year because obviously that will affect the brought forward balances, and you'll get that warning in CaseWare, which I'll show you in a moment. So in here, we're going to debit the P&L prior year adjustment code, okay, to take into account that effect on the brought forward balances. And we are going to credit the plant and machinery depreciation code by 25,000 to take into account the cumulative effect of all of those changes. Okay. Now, for that code there, the map codes that you need to use for that, we're going to jump into in a moment. Okay, so that particular part of the journal is going to be the key area for the prior year adjustment, and that's where you've got these different map codes here. So you've got HO3.49.00.50. Okay, now this is where it changes slightly, because if it's .50, that's the code you use if there's been an error. Okay, and if there's .51 on the end, that's the code you use if this is due to a change in accounting policy. Now this one is due to an error because we found out that the depreciation has been understated, and that's why for this one we're going to be using .50. Okay, but just to make it clear that that's where you make those changes there. Excuse me, I'm just going to pause my screen a moment and jump into CaseWare. Sorry about that.
Just while you're opening CaseWare there, Jack, we'll just clarify if you wanted a reminder later on about the differences between those two map codes, we can just pop it into the question field there, and we'll provide some guidance to you afterwards via email. But there is some guidance on the knowledge base that we can direct you to after the session.
Cheers for that, Tom. Yeah, sorry about that, guys. Normally I warn you before I jump into CaseWare, but forgetting that one today. So what we'll do here is we're now going to go into CaseWare and enter those adjustments that I just walked through there. Okay. Now you'll notice I've created these two codes here. Okay, this is just a very small set of data from our training data. We've got one code I've set up there ending in .50. Okay, and the other code just below it there set up .51. Okay, and that is just the difference between those two codes. As I mentioned, we've got the change in accounting policies and the error. All right. Now what I'll do is I've got the accounts open here. Okay, so we can have a look at these changes as we go through. But as we stand, we're going to make a change to plant and machinery under tangible assets. Okay, and it's going to affect this figure here. Okay, just so we've got some illustration later on. So if I jump into the adjusting entries tab now, the first journal I am going to set up is going to be the prior year adjustments journal. Sorry, not the prior adjustments journal, the prior year journal for the prior period. Okay, now it's actually key here, and this is something we get on support quite a lot, that if you're doing a prior period journal, that you make sure that the date for that is right. I know it sounds silly, but we get a lot of questions on that with things that haven't worked. So make sure that that says prior year 1 when you're doing this journal first. Okay, and as I said, we suggest doing the prior year adjustments before you come through to flowing that data into the current year. So I'll just give it a quick description for today. Now that, as we said, first of all, we're going to work out the effect on the comparative data, and that is going to be debiting the plant and machinery depreciation by 5,000, okay, and crediting the balance sheet charge code for that 5,000 there, okay. And if you remember back to our slides, we had the effect of prior years 2 to 5 to adjust the depreciation brought forward, and that will have been debited, credited 20,000, okay, and there will have been an adjustment to the retained earnings brought forward of 25,000, excuse me, okay, of 20,000, excuse me, okay. So what's going to happen there is that 20,000 will then affect the brought forwards for this year, as well as that 5,000 that's gone into the P&L for the prior year 1. Okay, so that's the prior year journal sorted. The next journal we're going to go for is going to be the current year journal. Okay, so if I click on new, this is going to be for the current year, so leaving it as 2019 in this example. Okay, and I'll just put prior year adjustment. So what we're going to do in here, if I do the credit first of all to the depreciation brought forward, because hopefully that's clear why we need that. So because of the effects of all of the prior year adjustments, there has been a £25,000 change to the current year in terms of the brought forward depreciation, okay? And this is where we then pick the prior year adjustment code, okay? And that is the ones we've set up here. And just as a reminder, if I click on properties, that's going to the .50 code here. All right. Now, if I come in there, and that's automatically calculated that for me, but that's just the effect of that £25,000 appearing there. Okay, so if I just fire that through to the accounts, we'll then see this balance here being affected. Okay, it's also affected the current year because obviously that data has flowed through to the current year figures. All right. Now I'll jump into those in just a moment, but just to show you guys that are getting used to doing this, you can see the adjustments in the adjustments column for the current year here. Okay, so it's quite clear that we can see the current year ones. If you want to see a similar table for the prior year data, if you double click on the prior year columns, okay, it will bring you this screen here. And in this screen, you can again see that the prior year adjustments in this column here, and we can see the journal that we put through for the prior year to make changes to that set of data there. Okay, so we jump into the accounts. As I say, we can see that this part has changed here. Now, if you remember our steps, our last step being step 4, okay, is just going to be how to show the prior year restatements. So if we jump to the notes here, sorry, within the notes. So as I mentioned, for the tangible fixed assets note, there is this prior year adjustment row that you can type in the effect that's taken place on the financial statements there, okay? Now, when we're doing this, the plant and machinery column is the one we're looking at today. So all we're going to do is jump into this prior year adjustment row, and that is going to have changed by 25,000, okay? Now, it's worth noting that this is actually going to be a credit entry for the purposes of this. It's going to change that negative because it's depreciation, and it's obviously the other way around. Now, what that does is CaseWare will then work out the difference between the restated amount here, which we've given it, which is taking from the map codes in the data here. It's taking that 82,885, okay? And all it's doing to get that 57,000 above it is taking away that 25,000 from this number to get this number here. What's important here is that the data that CaseWare is taking is that cell there. That's coming from the map codes. This one is using that cell minus the 25,000 in the prior year adjustment. Okay, so it's just one to make sure of there. The only other thing I want to show you is if it's not the tangible fixed assets. So if I jump to stocks, for example, okay, we've got this as restated column showing here. Now to get that to turn on, at the top here, if we go into table, and we've got under the restated section here, we can turn that on and off by clicking on the prior year, okay, just to make that appear or not appear. So if there's any changes that have been made, we can do that. And you've also got that option for prior year too, if that's necessary in this case. Okay, that's everything I was going to look at today, guys, but we can hang about. There's no rush at the end, so we can hang about for some questions if you guys have got them. So let us know, and I will speak to you shortly.
Thanks, Jack. So we are in the final minute of the session, so we have got time. I think we've got time for a question that's come in. Going back to when you were looking at when you were showing us posting the prior adjustment, and then you went to post the current year, and then we jumped to the accounts. The question is, what happens if you do the current year adjustment first before the prior year adjustment? So is that going to is the result effectively going to be the same, or is the file going to behave differently?
So the result will be the same if you did the current year journal first. The only reason we recommend doing the prior year first is that you can see the amounts that have changed in the retained earnings balances if there's been any changes there. So you can clearly see the adjustment that you need to put through for the current year. There's no reason that the software won't accept you doing the current year first before you do the prior year, but we just find it a little bit easier when we're showing people how to do it, that you can easily see the data that's changed.
Yeah, so it's sort of more methodical. Effectively, you're thinking a bit methodically. So you put in the prior year adjustment because that's where the error is, and then you're then going to put in the other side.
Yeah, exactly that. Yeah.
Okay. So excellent. We are out of time, or just about out of time. So thank you for your questions. What we'll do is we'll get back to you if we haven't answered your question live via email, and also if we've got enough questions, we'll create a Q&A document to accompany the recording. So as you can see on the screen here, we've got just a reminder that all of our past webinars, they are published to the knowledge base. You've also got the option now to watch those on our YouTube channel. So I'm actually keeping Jack on his toes because I'm talking about a slide that we haven't seen yet. So we'll do that in a sec. But we can see here we've got the upcoming webinars. So we've got our audit one, Mercia one, coming up next week. You don't want to miss that because we've got a representative from Mercia co-presenting. So good opportunity to put your questions to them. And then we've got in the new year our Working Papers 2020 session, just giving you an overview of what's new. The next slide is the one that I was just talking about, which is about where you can go to keep up to date with the latest content. So our YouTube channel, that's CaseWare CaseWare UK Limited, our client services page. That's where we have a dedicated playlist for our webinars. So this one will be uploaded to there very shortly. You've also got our LinkedIn page, which is where you can go and subscribe to be kept up to date with upcoming sessions and any new developments. You'll be notified. So that brings us to the end of today's session. Thanks very much for joining us. Thanks, Jack, for taking us through the adjustments there. If you've got any more questions, you can keep popping them into the question field. We'd very much appreciate your feedback through the survey that you'll see pop up at the end as well. We hope you enjoy the rest of your day and your weekend. Take care, and we'll see you soon.
Brilliant. Cheers, guys.